We can play cross fiat, but they're all lepers in the leper colony. Yes, there's an uglier leper that's closer to death than one that's just recently joined the colony. But the ideal trade is you want to get that Japanese yen trade.
Picking up pennies in front of a steamroller.
Exactly. Right. You get the yen financing, the carry trade, and put it in metals. And we called the biggest setup technically on gold yen some time ago, and that has been the mover, actually. If you're talking money and fiat and currency, you want to hold money versus the worst fiat. Currencies are pairs. Trade money against the worst fiat, and that was gold yen. And it will soon become silver yen, maybe, when the silver starts outperforming. Is given that I have access to gold, why do I want to trade a bad fiat against a really bad fiat? I just prefer the gold trade because gold is going up against all of them.
Federal Reserve Chair Jerome Powell's recent announcement suggests a potential monetary policy easing, with interest rate cuts possibly starting as early as September. This decision comes after a prolonged period of tightening to combat inflation and coincides with the upcoming U.S. presidential election cycle. The Fed's softened stance on inflation and neutral language regarding employment risks signals a potential turning point in its monetary strategy. Against this backdrop, FrancisHunt, the renowned trader and analyst known as the market sniper, offers a compelling perspective on the resurgence of gold's relevance in the current economic climate. Hunt argues that in an environment characterized by inflation and potential stagflation, gold is reasserting its role as a store of value. This view gains significance in light of recent market volatility, where gold experienced a sharp decline amidst a broader market sell-off. Despite this temporary correction, many analysts maintain a positive long-term outlook for the precious metal. Hunt's analysis extends beyond precious metals, encompassing a broader shift in global economic power. He points to the rising prominence of BRICS nations as Western economies face challenges, describing it as a sunsetting of the West and a sunrise for former communist states adopting more pragmatic capitalist approaches. This perspective aligns with the growing interest in the BRICS alliance, attracting new members seeking alternatives to U.S. dollar dominance in international trade. The BRICS bloc's appeal lies in its potential to offer developing countries a path to strengthen their local currencies and economies. Member nations are exploring alternatives to the U.S. dollar for cross-border transactions, including local currencies, central bank digital currencies, and even cryptocurrencies like Bitcoin. This trend reflects a broader desire to diversify away from dollar dependency and reshape the global financial order. Please tune in to explore FrancisHunt's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
During the 80s and the 70s with the Vietnam War and the bombing and the lack of the tie to the dollar, and when we went off sound money completely, the final severing, people had 5% of gold in their portfolios and people had gold stocks in the ideal portfolio. It just doesn't happen anymore. It's been the financial engineering cycle that went with the 40-year bond cycle, saw everything fiat groovy. Don't worry about it. Just put it on my tab. And that cycle has ended. And that killed gold. The 250 buy mark in 2000, that was peak.com. The heat map was all .com. Gold got absolutely slaughtered. Why are you holding this relic? It pays no income. It costs you to put it somewhere. That was the story. Warren Buffett has repeated similar things. Pet rocked him and all of this, and you have it in the ground. You pay to get it out of the ground, only to put it back in the ground, and all of these funny meme comments. Yeah. Actually, in an inflation, stagflationary environment, this is when it comes into play, because it will hold value. That's its job. And the dollar is in a super loss of value. And all fiats are. In fact, some more so, as we've mentioned, the yen. And that's the trade. That's why I wanted to bring in gold even with that. We can play cross fiat, but they're all lepers in the leper colony. Yes, there's an uglier leper that's closer to death than one that's just recently joined the colony. But the ideal trade is you want to get that Japanese yen trade.
Picking up pennies in front of a steamroller.
Exactly. Right. You get the yen financing, the carry trade, and put it in metals. And we called the biggest setup technically on gold yen some time ago. And that has been the mover, actually. If you're talking money and fiat and currencies, you want to hold money versus the worst fiat. Because that's currencies are pairs. Trade money against the worst fiat, and that was gold yen. Yeah. And it will soon become silver yen, maybe, when the silver starts outperforming. I've actually gone having a few in the BRICS nations, because what they're doing is they're sort of night and daying two halves of the planet. We are actually getting sunsetted on the west, and we might be getting sunrise. The old communist states are becoming pragmatic and sounding more sensible politically, and the old capitalistic nations are sounding more communist. And it also follows the traveling of the gold as well, the sensible, where the golden rule is he who holds the gold makes the rules, and we're seeing that going across. So there's a migration. Is given that I have access to gold, why do I want to trade a bad fiat against a really bad fiat? I just prefer the gold trade because gold is going up against all of them.
The United States is grappling with a burgeoning fiscal challenge that threatens to cast a long shadow over its economic future. Despite a seemingly robust economy, government borrowing continues unabated, pushing public debt to unprecedented levels. This situation has drawn the attention of financial experts like FrancisHunt, who warn about the unsustainability of current borrowing practices. Hunt points out a startling statistic. The U.S. creates approximately $1 trillion in new debt every 100 days. This massive borrowing spree funds the nation's infrastructure and maintains its high standard of living, but it comes at a steep price. The rapidly accumulating debt raises serious questions about long-term economic stability and the country's ability to meet future financial obligations. Current projections paint a sobering picture. The government is running a primary deficit of roughly 4% of gross domestic product, with inflation-adjusted interest rates increasing with growth. This imbalance is driving debt levels to new heights. According to official estimates, from its current position of just under 100% of GDP, public debt is expected to balloon to 122% by 2034. The relative silence on this issue from political leaders and presidential contenders is particularly concerning. Economic policy discussions, when they occur at all, tend to focus on tax and spending proposals that could potentially exacerbate the fiscal outlook, rather than address the underlying debt problem. Let's get back to the interview.
There's this whole system that is asset creating. They call them assets, and it's the borrowing mechanisms. And if we look at this beautiful country that we're in, and the beautiful wide roads, and everything looks awesome, we're also got to remember that they're creating $1 trillion in new debt every 100 days. Many people quoting the statistic now. And where is it going, and what does it mean? And how does it impact the fact that the sun still rises and Miami is still a cool place? It's very serious, because basically the rest of the world, people buying the other end of that as an asset, are allowing you to run an overdraft, basically. So you have consumer overdrafts. You ask, what kind of are we talking? They were all a problem, by the way. So subprime cars, student loans, consumer loans, credit cards, there's a record high. There's over $1 trillion at 21.3 or whatever it is, average pay rate on credit card debt. So you're seeing we're in a consumer and retail recession as far as I'm concerned. We met the criteria a long time ago. They changed the criteria. We're still in that recession, in my opinion, for the consumer. And that's why people are wondering about rate cuts. But the problem that comes with the rate cut is actually everyone feels, and this is such an important point, so I'm going to underline and put an interrogation mark here. Everyone thinks the central bankers set the rate. In the big normal environment, they do. But many forget that, for example, the British changed interest rates twice in one day during the crisis of George Soros shorting the pound. No. And that was not because they changed their mind after tea. They had a bad cucumber sandwich and thought, damn, let's rethink that one. That was because they were forced to. The markets will set your rates.
One term I've heard the last couple of days quite often is bond vigilantes.
Yes.
Is that who you're talking about?
There is an element certainly of that. In other words, people say, I'm not buying any more of this. So when we refer back to that $1 trillion every 100 days, people are, the government of America is expending that amount of additional money, and they're not getting it in tax. So basically it's an extension on credit card. And somebody is saying, I will buy that and own it as an asset, because I will get paid that money back after the 10 or the 20 or the 30 years, and in the meantime I'm going to get a yield. And we've always had as a basis, so I did an MBA, most of us did, the cost of capital is risk-free rate, I put that in inverted commas, is the 10-year treasury. Because if your business doesn't generate X return, you may as well just put in the treasury and pick up the yield. So that's the hurdle rate, because the minute you run a business, you're taking on risk. The debt markets no longer deserve that risk-free rate monitor. In fact, they are actually going to devalue on you through many different ways. And you've already seen it. The long term, by driving the interest rates up as fast as they did, during this last tightening cycle, you've actually had the 30-year lose 45% to 50% of its capital value. So that means as an investor, and there's all these city bankers, there's pension funds, so now you have to stop being a consumer and just understanding Coke and Toyota and everything you touch, and realize that the government has created this product that other people were prepared to purchase because it was an investment, and it provided income streams so that they could fund their pensions, they could meet other requirements. They were receiving investment capital. You have the Californian Teachers Fund, for example. You have all of these things that are actually big, and they need to park up money that they're being allocated to pay future liabilities. Now, if you have a capital devastation of 45-50%, what you actually have are pension fund managers that have just watched a cake shrink immensely, and they have to, off the income stream, make good their liabilities. And when they don't have sufficient income stream, they have to use some of that capital. Now, if that capital's just halved because you're sitting with a portfolio of long-term debt, which is what the recent run in the debts from near zero to the current levels has done. You're seeing international central banks decide, well, we don't need to hold so much. We're not spending as much in dollars because we're doing, bilateral trade with Russia, if you're China, and in yuan or rubles. Yeah. And as a result, you're saying, I don't need to hold as much dollar-denominated assets. And they've just handed me a 45-50% loss. So actually, this is no longer looking such a good thing anyway. So they become net sellers. So the problem then comes when you're issuing ever more because you're spending more than you're living, is who's going to be your new buyer if your old buyers are no longer buying, and in fact they've become additional sellers. So there's not a bid anymore.
As the debt clock ticks ever upward, the need for a serious national conversation about fiscal responsibility becomes increasingly urgent. The challenge lies in balancing the desire for continued infrastructure investment and maintaining living standards with the imperative of sustainable financial management. Without addressing this growing debt issue, the United States may find itself facing severe economic constraints in the not-so-distant future, potentially compromising its global economic standing and the financial well-being of its citizens. Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.